One thing that we saw done last year, and I don't know if you've seen this, we found it quantitatively. Last July, when we had PPI at decade highs, same thing with CPI, all of a sudden, and Don Cox has talked about this, he called it his Saturday night massacre, huge short positions in the TOCOM, and all of a sudden commodity prices just began to plummet in July. In August, and at that point, the economy wasn't as bad as it ended up being in the fourth quarter, and people were scratching their head. We went from 1 month worried about the highest inflation rates to the following month, the topic changed to deflation. And there was a thesis that, the central banks or the Fed might have done something to engineer a drop in commodity prices because the futures markets were pricing in 3/4 of increase in interest rates in the Fed funds rate by the end of the year. And then all of a sudden commodities fell off a cliff. And one thing that I always thought was rather strange is the two hurricanes that we had, one I think at the end of August, beginning of September, and 2 weeks later another hurricane. And as soon as the hurricanes hit, the price of oil got whacked, went down $5. The next hurricane comes a week later, it gets whacked, it goes down $5. And they were saying, well, the damage wasn't as bad as expected. And I'm thinking, wait a minute, did some suit from Wall Street get on a jet and get on a helicopter and fly over the Gulf? One thing that we saw now that we can look back in retrospect is the Fed engineered a $600 billion currency swap with foreign central banks, which bought dollars in treasuries. And before that, they were saying, well, there is a dollar shortage. Well, how could there be a dollar shortage if the dollar was declining? Have you any thoughts on that, or have you heard that story?
No, I really hadn't heard that story. It's very, very interesting. Don't really have any clear thoughts on it, but, boy, that's something I'm going to see if I can get more information on.
James, let me send you a graph. I've got a graph that shows the dollar going down. Then it shows the currency swap, and with the currency swap, you can see the treasury purchases, you can see the dollar rise along with the currency swap, and then as the currency swap begins being reversed, beginning in March, what does the Fed do? It announces quantitative easing, and we've got Fed purchases and bank purchases of treasuries. Let me send you that graph because it's a remarkable graph, and you can see how they engineered this.
Yeah, I'd love to see that. Ever since the whole quantitative easing thing, really what that is the central bank turning federal government debt into currency. And that's the road to hyperinflation. And, Jim, I think we're very, very close to hyperinflation in the United States. The cause of hyperinflation is always the U.S. government, is the cause of a government borrowing too much and the central bank turning that debt into currency because the market's unwilling to lend, to the government itself. And this is exactly what quantitative easing is. We're on the road to hyperinflation. I think it's going to happen very soon. I'm not talking years. I'm talking, end of this year, first quarter of next year. I think the signs are going to be there that the tipping point has already been reached. Confidence in the dollar is being eroded. We see it all the time internationally by countries asking for additional reserve currencies. A few weeks ago, the United Nations Council on Trade and Development, UNCTAD, came out with a report also suggesting there should be other reserve currencies. And all of these things ultimately are going to diminish the demand for the dollar, and that's going to increase the purchasing power of gold as we go forward from here.
Couldn't agree more.